Okay, good evening. Please come to money market instruments. In this segment, we are going to learn various types of money market instruments and their features, advantage, sometimes disadvantage, and we'll solve few questions also. So today I have got 7 questions for you to be solved in the class. Okay, ready? So what do you mean by money market instrument? These are the short-term instruments, okay, used in the money market. Short-term instrument used in the money market to borrow money or lend money. Normally these are very liquid, very safe. Okay, maturity period may be 1 day to 1 year also, and these are regulated by RBI. So now the same thing we'll discuss. What are the benefits? How does it work? And an important segment of this chapter, money market instrument. The money market in India is an important source of finance. Is an important source of finance to whom? To industry, trade, commerce and government sector. That means businessman uses money market instrument like commercial paper. Okay. Bank use certificate of deposit. Government use treasury bill, government bonds. For both national and international through bills, treasury or commercial paper and other financial instruments, and provides an opportunity to the banks to deploy their surplus so as to reduce their cost of liquidity also. Like any other financial instrument, money market also instrument brings these two parties together. Who is this one? The one who has surplus. Who is this party? The one who has deficit. These are brought together. Surplus party benefits, he enjoys the interest. Deficit party enjoys because he gets to use the funds for that period. Okay, so this way it is a win-win situation for all the participants, which we saw yesterday. So now next is important features of money market instruments. Money market instruments are characterized by short duration, which can be as short as just 1 day, large volume, crores of rupees, thousands of crores of rupees. When RBI does the auction, it may auction treasury bills of 5,000 crore rupees in one single day, maybe more. Then interest rates are now deregulated. For most of the instrument, let the market decide. Demand and supply of money will decide the interest rate. So in fact, this is a common answer you can write in many instruments, and the instruments are highly liquid. They can be easily, quickly converted into cash without loss of time and value. However, there may be some restriction in case of some instrument. Okay, that we will see. In some instrument, you cannot transfer it for 1 month period. So that much liquidity is not there. Sometime you cannot transfer it for 3 months. Sometime you can't transfer it also. So this liquidity criteria may vary from instrument to instrument also. For some there may be secondary market, for some there may not be secondary market. Government is trying that these instruments are very liquid, so that more and more people will participate. Most of these instruments are again safe in nature. Risk is less. For example, treasury bills are issued by government. Risk is less. Certificate of deposits are issued by commercial bank. Again, risk is less. Commercial papers are issued by reputed corporate houses after fulfilling the necessary conditions laid down by RBI. So even commercial papers are usually secured. The traditional which are the traditional money market instrument? Which are the usual money market instrument? So I have made a small list. We will discuss in detail in the next paragraph. One is call and notice money. Call and, but with limited players only. Majority of these transactions takes place between banks and banks only, or banks and financial institutions. Okay, that is the bank which has surplus lends money to the bank which has deficit. Then treasury bills. This is another important instrument used by government to raise short-term funds. Commercial bills. That is what you learn, bill of exchange, which is discounted. You can also add commercial paper. Okay. The new money market instruments were introduced. Some new money market instruments are coming in the market, giving a wider choice to short-term holders of money to reap yields on funds even for a day. So you can earn interest even for one day also in this money market. Okay, why to keep money idle? If you have say 20 crore rupees, invest it for 2 days also. If you have 2 days surplus, you will get thousands of rupees in interest. Okay, or to earn a little more by parking funds by instrument for a few days more, or until such time till they need it for lending at a higher rate. You may find this sentences boring, but if you become treasury manager of a big company which has a surplus of 1000 crore rupees, you can't keep it idle for even one day. Keep in mind, otherwise your boss will ask you to get out. Boss will say whatever salary you are drawing, more than that you have incurred a loss on interest. Is it right? You should know how to park the money. And not only that, you have to see during the given period what is the best instrument available where you can park your temporary surplus. So before you leave office on Sunday or Friday evening, and if you have surplus, they park it so that Saturday, Sunday, you enjoy the interest. That is also their plan. The instrument used by the above mentioned players to borrow or lend in the money market include, you will find lot of repetition of the instrument. Treasury bill is used, GOI, Government of India securities, state government securities, PSU bonds, commercial paper, certificate of deposits. Okay, these are some of the instruments used in money market by the borrowers and lenders. Next is banks which require short-term funds. Would banks which require short-term funds borrow or sell these securities, and those having surplus fund would lend or buy the securities. Repetition. In money market, there is a lot of transaction between banks and banks. Even for one day, 3 days, they borrow or lend. So the one which has surplus will lend money to the one who has deficit. Banks experiencing a temporary rise in their deposit, possible, and hence a temporary rise in their SLR obligation. Is the statement right? If your deposits go up, your SLR will also go up. True or false? True, because SLR has to be 20% of deposit. So if deposit go from 100 crore to 200 crore, SLR will go also from 20 crore to 40 crore. So what you will have to do? Then they will have to invest in this money market instrument. Hence a temporary fall in their statutory liquid ratio obligation can borrow or lend SLR security from those experiencing a temporary fall or rise in their deposits. On the other hand, there may be a bank whose deposits have gone down, so their SLR requirement will also go down. So why to keep excess SLR instrument? it will be transferred to this bank which require more SLR instrument. That is the meaning of this paragraph. Little complicated for you, but it simply means how do the banks manage their liquidity as well as SLRs. So the one whose deposit will increase will require more SLR. The one whose deposits have decreased will require less SLR. So this bank whose deposit have increased will purchase such SLR securities. Treasury bill is one of the SLR securities from the other banks. Now you tell me question, why do banks invest to fulfill their, where do banks invest to fulfill their SLR obligation? Where do banks invest to fulfill their SLR obligation? Banks invest in one, treasury bills. Suppose you have surplus money and you have to keep 20% of your time and demand deposit in liquid investment, the best is treasury bill. Or you can invest in central or state government securities. Everything is printed in your book. Only 7 questions you have to write later. Government guaranteed bond and PSU bonds to fulfill their SLR obligations. So usually you can say banks invest in government securities, which may be in the form of treasury bill or central or state government securities or bonds issued by PSU but guaranteed by the government. Okay. Now we will see in the next few minutes one by one each instrument. Is it right? So what is the first instrument we are going to see now? Call or notice money. Call or notice money. In your banking company final account chapter also, there was a heading in the asset side, money at call and short notice. Money at call and short notice. This is that item. It is an advance given by one bank to another bank for a very short period. For a very short period which ranges from 1 day to 14 days. So this is suppose Punjab National Bank. Okay. This is Yes Bank. Punjab National Bank has surplus. So it will lend to Yes Bank. And the period can be 1 to 14 days. So mostly it is followed amongst the banks. Okay. So it helps in evening out the liquidity in the banking sector. Interest rates are market driven. I have told you yesterday, if there is a huge demand for funds, interest rate can be 70% per annum also. If there is no demand, low demand, 1%. It varies from season to season also. Okay. During harvesting seasons, the interest rates are very high. So now we will read line by line and I will explain. Pay attention. Call money market or interbank call money market is a segment of money market where scheduled commercial banks lend or borrow. One party is lending, PNB, Yes Bank is borrowing on call. On call means overnight or for a short period or at a short notice, that is for a period up to 14 days. It is called notice money because you have to give a notice if you want to get it back earlier. 3 days notice will be required. If it is a notice money, PNB will have to give a 3 days notice to Yes Bank. But if it is money at call, then there is no notice period. After the call is made, the other party will have to make the payment. So money at call means no notice period. Money at short notice means 3 days notice are required. Okay, to manage the day-to-day surplus and deficit in the cash flow. Very popular in the banks. These days, today's surplus and deficit arise due to very nature of their operations. What is the business of a bank? Management of basically liquidity. Sometimes there may be huge demand for funds. Clients may demand a lot of money. There will be a lot of withdrawals. Okay. Sometimes there may be surplus. A lot of installments and loans are getting deposited. Okay. Some clients may have prepaid the loan. Possible. So therefore, what to do? Call money, notice money can be used. And the peculiar nature of the portfolio of their assets and liabilities also, because they have to invest in SLR to meet requirement. They have to invest in liquid assets so that in case if the need arises, they can immediately use it. So because of that, surplus or deficit can arise. Now, location. Where is the transaction taking place? The core of the Indian money market structure is the interbank call money market, which is centralized primarily in Mumbai. So Mumbai is the center for call money operations, notice money operation, but it has got some markets in Delhi, Kolkata, Chennai, and Ahmedabad. And what is the duration? You have to remember, or at least you should know that these are the answer printed here. It is taken from your ICI module, but I will request that at a day or 2 days before the exam, should have a quick look at the RBI website also for some facts, like for example 14 days interest rate, etc. Okay, because this might change. So the activity in the call market are confined to interbank business, predominantly on an overnight basis. Overnight basis means only for a single day, one day. Although a small amount of business known as notice money was also transacted side by side with call money with a maximum period of 14 days. So 1 to 14 days is the time period. Participants. Now they have divided the participants into two types. Which two types? Those who can borrow as well as lend in the market. Those who can borrow, underline, borrow as well as lend in the market. Now they are RBI, commercial bank, cooperative banks and primary dealers. Even UTI also. But in the institute note they have mentioned this. There is some inconsistency in the notes, okay? And those who can only lend as a financial institution, now here they mention LIC, UTI, GIC, IDBI, NABARD, ICICI and mutual funds. But if you see the earlier page, that it was mentioned that the list was later expanded to cooperative bank, term lending institutions such as IDBI, etc., mutual funds launched by public sector bank and investment bank, etc. Okay. So now I think they have also allowed the UTI also, and mutual funds can also borrow. Then what was the three reasons for which mutual fund can borrow? Mutual funds can borrow to pay dividend, interest and redemption obligation. So you read para 1.11 also. Read para 1.11 also for the exact parties, because this list keeps changing. That is why I said maybe the institute have not taken care of this inconsistency in their notes. Okay, this list keeps changing because earlier only these were allowed, then UTI was allowed, then mutual funds were also allowed. So keep paragraph 1.11 also along with this. Then corporate entities having bulk lendable resources of a minimum of rupees 5 crore. Now this was not there in the paragraph 1.11. Corporate entities who can lend up to rupees minimum 5 crore per transaction have been permitted to lend in call money through all primary dealers, provided they do not have any short-term borrowing from the bank. So can corporates lend in call money market? Yes, but through primary dealers, and they should not have bank borrowing. Otherwise they will borrow here, invest here, and maybe they can make profit due to the difference. So their activity will change from doing business to borrowing and lending. So they will not be able to focus. Is it right? Bank brokers are not permitted in the call money or notice money market. So you have to directly deal with the counterparty. Brokers are not permitted means the two parties will have to directly interact with each other. This is about participants. Brokers are not allowed. And now the next paragraph number 4, features. Current and expected interest rate on call money are the basic rates to which other money market and to some extent the government security markets are anchored. Now the meaning of this is that call money or notice money rate influence the other rates in the market, because large amount of funds are being borrowed or lent in this market. So therefore it acts as an indicator of what the interest rate in money market is going on. As a result of that, the interest rate even on the government securities are influenced. So the question is, can call or notice money market form the basis of indicator of interest rate in the money market? Yes. How are the interest rate decided in the call money market? Underline, it is market driven and is highly sensitive to the forces of demand and supply. I have read in so many other books also that the interest rate sometimes goes down to 1%, 0.5%, and sometimes 40, 50, 60, maybe up to 70% also. Okay. So within one fortnight means how many days? 2 weeks. Fortnight means 2 weeks. Rates are known to have moved as high as 70%. Institute have written, only they did not type in the study material this 70% figure. Rate can move as high as, fill in the blanks, this 70%, and or touch level as low as, this is printed, 0.5% to 1%. Hence the participants in the money market are exposed to high interest rate. Intraday variation is also quite large. Intraday variation. What is intraday variation? Within a day also, maybe in the morning the rate may be different, in the afternoon or evening the rate may be different, and therefore because of the volatility in the interest rate, the participants are exposed to a high degree of interest rate risk. You may have borrowed at 40% and then later on you find, oh, the rate has gone down to 10%. So you have lent at 5%, but by evening the rate goes to 20%. So you would have thought, oh, I should have charged 20%. Value of the instrument also changes because of interest rate. So the call money rates have been fluctuating widely, going up to 70% as per ICI material and dropping to around 3% in the recent past. So that is why I have written 70%, taking help from this sentence. For many years, while a set of institutions like SBI, UTI, LIC, GIC, etc. continue to be the lenders, some banks which have limited branch network are regular borrowers. Who are the main lenders in this market? SBI, UTI, LIC, GIC. And who are the borrowers? Those banks which have limited branch network. Why? If you have limited branch network, you have limited deposits. Yes or no? Your ability to mobilize the savings or open current account will be limited. So therefore, you don't have so much of funds. SBI has, I think, more than 10,000 branches now. So therefore, they are able to mobilize more funds. LIC, GIC, UTI, these are respective monopolies in their field. Okay, if not monopoly, but still they get a lot of funds, and therefore they have the ability to lend. Now the question is, why call or notice money is very volatile, 3% to 70%. Before reading this chapter, I was also not aware that it is so volatile, up to 70%. What is the answer? Business model is such, it is possible. Then demand and supply fluctuate a lot according to the season, right? Like for example, it's written that activity in the money market are subject to fluctuation due to seasonal factors. Very busy season, November, December, maybe up to April, because of agriculture, demand goes up. And these are the festival seasons also in India. Do you know that? Which is the biggest festival in October, November? Diwali, Dashera, Christmas, New Year. Huh? ICA exam. Oh my God. Don't remind me. It's very dangerous. And some seasons are slack. May to October. So demand is very high compared to supply. Interest shoots up like anything. And May to October, no demand. Funds are idle. 1%, 2%, 3%. Second reason for this huge volatility is the liquidity management. One of the most important factors contributing to volatility in the market is mismatch in the assets and liabilities created by the bank. Okay, mismatch in the asset and liability. Assets may be invested in long-term instrument, government bond of 5 years. But you have to pay liabilities which will become due tomorrow. Okay, vice versa is also possible. FD is for 5 years. So once you take money, enjoy. But the loan may be such that you have to continuously, the loan that you give, you keep on receiving the money. So surplus gets generated. But FD will be repaid afterwards. But they can't help it. That is their business model. And if such is the business model, you are bound to have surplus or deficit. So some banks have overextended themselves by using call money borrowings to finance the build-up of a large portfolio of Government of India security. Other long-term asset, non-food credit, where they are investing this money raised from call money, they are using it to purchase long-term bonds, non-food credit, because these are for long-term. So there is bound to be mismatch. So more and more you will borrow, more and more demand, more and more interest would rise. It is this asset liability mismatch which resulted in a sporadic volatility in the market. Non-food means non-agricultural credit, non-food, other than food sector. Okay. Now I'm going to dictate one question. Write one small question in the notebook. You have to write few questions. First, write down ASF Bank. Only for example, ASF Bank placed rupees 52 crore ASF Bank pays rupees 52 crore in overnight call. In overnight call with a foreign bank, for a day, in the overnight call, for a day in the overnight call. The rate ruled at 5.65% per annum. What is the interest rate they have charged? 5.65% per annum. What is the amount? What is the amount it would receive from the foreign bank next day? What is the amount it would receive from the foreign bank next day? So first you will try. Simple question. You have invested 52 crore or lent 52 crore just for one day. Just for one day. Simple interest formula. Principal into rate into time. 52 crore into 5.65% into 1 by 365. You can take 365. Doesn't matter. Your answer will be more or less same. And add 52 crore again. Principal. So you will receive how much total amount next day? Principal plus interest. So write down answer. Amount received next day equal to. Amount received next day equal to principal plus interest for a day. Principal plus interest for a day. 52 crore plus 52 crore into 5.65% into 1 by 365. This is interest. Simple interest formula. Principal, rate, time. Now you give me the final answer in all digits. Maybe the last digit can be rounded off in nearest rupees. Huh? Just check. Is it 52 crore? 80,000 is there? And 493. No problem. Round off this last digit. So even for one day if you put money, it is equal to your stipend for 2 years. For at least 1 year. For some people. 2 years. And this is just 52 crore. Actual amount may be much bigger than this. So that is why this job is very sensitive. You have to manage money on a daily basis. You can't keep surplus. One more question I will give you. Reverse working. From the answer you have to find the main data. Please write ASF Bank. Which bank? ASF Bank borrowed. Question number 2. Call money for 3 days. Borrowed call money for 3 days in the overnight call money market. In the overnight call money market and paid rupees 152 345 and paid rupees 152 345 for these 3 days. For these 3 days on a borrowing of rupees 40 crore. What is the implied call money rate? This is money, one single word. Call money rate. What is the implied call money rate? So you are given interest, simple interest formula, left hand side of the equation, time 3 days, principal 40 crore. R you have to find. Such questions you have solved in schools also. When you are in half pant. Naked? No, I can't say that. You have to maintain some basic decency in the classroom. So you said knicker. I thought naked. My mistake. What is the answer? Yes. Check the answer. Around 4.636465 you are getting. What you do, just simply apply this principle into rate R by 100 into time 3 by 365 and equate it with 150 to 345. So therefore R is equal to 4.63%. So this is one instrument called interbank call money. Now there is interbank term money. Interbank call money, interbank term money. Main difference is the period. What is the main difference? The time. Call money is usually for 1 day to 14 days. Two examples will help you to understand the concept also. And this is for few months, say 3 months, 6 months. So it ranges from few months like 3 months to say 6, 9 months, 12 months. So that is what is called interbank term money. Basic logic here also is the same. One bank lends to other bank, interbank term money for a small term, short term. The one who has surplus lends it to the one who has deficit. So this market, which was exclusively for commercial bank and cooperative bank, as I have told you, there is a lot of regulatory changes in this market. Originally, it was only for commercial bank, cooperative banks because they were more regulated. Then it has been opened up for select means not all but few, all India development financial institutions in October 1993. What is the meaning of DFI? Development Financial Institutions. Already written here, DFI. Development Financial Institutions, that is DFI, are permitted to borrow from the market for a maturity period of 3 to 6 months within the limits stipulated by RBI for each institution. So there is a lot of RBI regulation here. DFI can borrow, okay, but subject to RBI regulation, and the time limit is 3 to 6 months. What about the interest rate? Market driven. One of the drawbacks of this market is lenders in the market cannot prematurely recall these funds. Lenders cannot prematurely recall these funds. What is that? It means you have to wait till maturity. Notice money you could have called back by giving a 3 days notice. Even if you have lent for 14 days, but maybe you need funds after 4 days, you can give a notice. And as such, this instrument is not liquid. Question for you, why do you think interbank term money market is likely to develop? Do you think this market is going to develop in the years to come? Yes. Interbank term money market is likely to develop in the next few years for the following reasons. First is declining spread in lending operations. What is the meaning of spread? The difference between the rate at which they borrow and the rate at which they lend. Is it right? Competition has increased now in the banking sector also. Not only between banks but other business models which have grown. is also giving them competition. Fintech companies are coming in the market now. What is fintech companies? Huh, they have designed app, and over the app only they can lend you money in few hours. Is it right? You just give your Aadhaar detail and some other detail, which again you have to upload only on their website or that app, and you can get the loan if you are eligible. Is it right? So a lot of competition in the banking sector. Non-bank finance companies have mushroomed like anything, so they are giving tough competition, and a lot of mobile apps are coming into this field that will really change the way the banks will operate. They may threaten the existence of the banks also in the years to come. Not now. Yes, you should visualize what will happen 5-10 years down the line if people don't go to banks only for either their deposit requirement or their borrowing requirement. Then why will bank operate? So what these apps will do, just for general knowledge, they have created a platform. You have surplus money, you give loan. Bank will give you 6, 7, 8%, but these apps will give you 12, 13%, 11%. You are happy, and then they will charge 14%, 15% to the borrower, which otherwise bank charge even a high rate of interest to them also. So that range they have reduced. The depositor gets more, the borrower pays less, because the operating cost will be very low with these apps. It's a software, and through which most of the things will be done. Okay, so that is why the note says declining spread in lending operation due to huge competition. Then next is volatility in the call money market, growing desire for fixed interest borrowing by corporates, and move towards fuller integration between forex and money market. So forex and money market will also get integrated. So this means the demand for money will grow for short period, and this market will grow. Stringent guideline by regulator or management of the institution. So these are some reasons they have mentioned for growth in interbank money market, interbank term money market. Interbank call money is different, interbank term money is different. Call money is for short duration, term money is for few months. Now, tick, very important. Interbank participation certificate, IBPC. In fact, they have asked this question in the old SFM exam. What they have asked in the SFM exam is also applicable to you, because it was there in the old SFM theory section. Now they have made a subject out of it. IBPC. First I'll explain you the concept, then the note will become easier for you to understand. Suppose this is Punjab National Bank, okay, and this is a borrower. So borrower goes to PNB. PNB lends to borrower. Let us say 50 crore rupees. 50 crore lent by PNB to the borrower. Then PNB's liquidity will become tight now. Yes or no? If you give 50 crore rupees to one borrower, your liquidity position will become tight. Second reason, second problem, risk is also too high. Risk is also too high. Is it right? This borrower is some N Modi, okay. We don't want to write full name. Later on, I can always change my statement. So there is a risk that he may not pay. One, liquidity. Second, there is a risk involved. Okay. So what do? They go to another bank. Yes Bank. And then they share a portion of this loan with Yes Bank by issuing a certificate known as interbank participation certificate. So Yes Bank will say, okay, I am willing to share 50% of this loan, 25 crore. So now 25 crore loan will be shifted to Yes Bank. That is interbank participation certificate. So this will remind you of one concept in insurance. Reinsurance. Similar to that. But you don't mention reinsurance anywhere in your answer. You can mention it is a type of consortium financing. Spelling is wrong. Wait. It is like consortium financing. Sir, what is consortium financing? It means two or more banks come together to finance a big loan. Earlier, consortium financing was common. Earlier, because earlier banks did not have so much of money. So if somebody wanted to borrow even 5 crore rupees, 5-6 banks will come and give him a loan of 5 crore rupees. Okay. But now because banks have lot of funds with them, they raise money through issue of share, debenture, FD mobilization. They can borrow from RBI. Right. They have more and more branches now. So consortium is not compulsory. If you on your own can lend 50 crore rupees, you can. Right. Earlier RBI had up to a certain limit, it's okay. But beyond that, the loan has to be shared by two or more bankers. Now there are two types of IBPC also. One is with risk and one is without risk. With risk means in case if Mr. N. Modi does not pay, then Yes Bank will also share the loss. And without risk means Yes Bank will not share the loss. Okay. So now I will read and then you will understand. But have you got an overall idea? It is just you are sharing a loan. You can give it to more than one parties also. Benefit to each party. Borrower gets funds. PNB negotiates with the borrower. The rate of interest at which PNB will shift to Yes Bank may be different because that is another negotiation. That may be another negotiation. Okay. But at least that Yes Bank is happy. I got a ready-made borrower, a big borrower, and already PNB has done the due diligence. All documentation with the borrower, negotiation, all those formalities which takes a lot of time have already been done by the one of the banks. Is it right? So this is called IBPC. IBPCs are short-term instruments to even out the short-term liquidity within the banking system. Like in the previous example, PNB will be able to raise funds. It needs money and Yes Bank had a surplus, so it can lend money. The prime objective is to provide some degree of flexibility in the credit portfolio of the bank and to smoothen the consortium arrangement. So it gives flexibility to the banks. They can lend money at the same time. They can use this instrument to raise funds also. Okay. Flexibility is there. They can lend money to N. Modi and they can also raise funds from Yes Bank using this IBPC. So therefore it is similar to, they have used this word also in the notes, consortium arrangement. Means two or more banks coming together is called consortium arrangement. The IBPC can be issued by commercial bank and can also be subscribed by any commercial bank and can also be subscribed by any commercial bank. IBPC is issued against any underlying advance classified as standard. So this loan and advance should be standard against which IBPC is issued. Okay, where is that N Modi? Gone, no problem. So N Modi should be classified as a standard asset in the books of Punjab National Bank. You cannot issue IBPC against a substandard or a doubtful or loss asset. Do you know 4 types of assets are there? Standard, substandard, doubtful, loss. And there are 2 types of IBPC, with and without risk to the lender. That means yes bank can enter into with risk or without risk. While the participation without it, that means yes bank says no, I don't want to take the risk of bad debt. If N Modi does not pay, I am not responsible. I will recover money from PNB. So that is called without risk. Then the RBI regulation says the maximum period of IBPC in that case cannot be more than 90 days without risk. But if it is with risk, then the period can range from 91 days to 180 days. What about the interest rate on IBPC? Interest rate on IBPC between Yes Bank and PNB is freely determined by the market rate. Between that N Modi and PNB, they will negotiate, again depending upon the credit rating, etc. But between bank and bank, again it depends on that day what is the rate of interest. The certificates are neither transferable nor prematurely redeemable by the issuing bank. So this time this instrument does not have liquidity. Yes bank cannot prematurely offer the ask for redemption, or it cannot transfer also. The participating bank would show the aggregate amount of such participation as a part of its advances. So it will appear as an advance in their balance sheet in cases where risk have been materialized and Modi does not pay. Risk have been materialized. The issuing bank and participating bank should share the recoveries proportionately. But in which type of IBPC? With risk. This sentence is applicable for with risk. The note also says, however, in without risk sharing management, which means the previous line is applicable for with risk, the issuing bank will show the amount of participation as borrowing. The issuing bank will show the amount of participation as borrowing because he has kept the risk with himself. Okay. If you keep the risk with yourself, it means you have not transferred the instrument to others. Long back in FR batch, you have studied financial instrument chapter. When should you de-recognize a financial instrument? When the significant risk and reward of ownership has been transferred. So if PNB says I am going to take all the bad debt risk on myself, then the amount lent by Yes Bank to PNB will appear in the balance sheet of PNB as a borrowing from Yes Bank in case of without risk. For accounting purpose, if PNB is responsible for the risk, then loan, it will appear as a borrowing from Yes Bank. If PNB is not responsible, then the instrument is de-recognized. Loan is de-recognized and it appears in Yes Bank's book as advance. Okay. In case of loss, the issuing bank should compensate fully the participating bank. Without risk. This sentence is applicable to without risk. So if there is no transfer of risk to the participating bank. In our example, continuously the participating bank is Yes Bank and the issuing bank is PNB. If it is without risk IBPC, then all losses will be borne by the issuing bank. Any loss to participating bank will be compensated by the issuing bank. The scheme is beneficial both for issuing and participating bank. Issuing bank gets funds, participating bank is able to invest money. So the issuing bank can secure funds against advances without actually diluting its asset mix. To the lender, it provides an opportunity to deploy the short-term surplus funds in a secured and profitable manner because they don't have to take so much of headache of identifying a borrower, because that is also a task in the banking sector. Yes or no? To find a borrower of 50 crore on a daily basis, is it possible? And here you have a borrower who has already been properly analyzed by one of the banks, and of course they will look at the credentials of the bank who have given the loan. The IBPC with risk can also be used for capital adequacy management. What is capital adequacy management? There is another chapter in your syllabus banking, where we'll see capital adequacy ratio coming soon. Okay, but for the time being, you have learnt in your advanced accounting banking company, banks have to maintain a ratio called capital adequacy ratio, which is tier 1 capital plus tier 2 capital upon risk weighted assets and off balance sheet items. Risk weighted asset means those assets which have risk are assigned more weight, and those assets which have less risk are assigned less weight. That means according to the riskiness, weights are assigned. Okay. So earlier you had given loan to N Modi. It was appearing as a risky asset. Loans and advances are appearing as a risky asset. So this denominator will become heavy. So you need more tier 1 and tier 2 capital to match that. Otherwise this ratio will go down. If denominator is heavy, ratio goes down. But if I transfer a portion of that loans and advances to other bank, this figure will reduce. It will be substituted by cash and bank account debit to advance to N Modi, derecognized. And therefore, if you reduce the denominator, mathematics everywhere, your ratio will go up. So in fact, some banks can use this IBPC for increasing their capital adequacy ratio also. But that will be only if you can transfer it with risk to participating bank. Okay. The next is a bank with capital shortfall can temporarily park its advances with other banks which have surplus capital. So one bank which have a more capital adequacy ratio, more than the required amount. Say one bank has 12%. Right now, to my understanding, CR requirement is 9%. Okay. Another bank has 8%. So what they do, the one which has 8% will transfer some advance to the one which has, let's say, 12%. So its CAR will go up, their CR will probably go down. India is a land of jugadus. Okay, banks also do that. Even the institute note says a bank with capital shortfall can temporarily park its advances with other banks. So towards the year end, this kind of adjustments they will do, because then RBI will otherwise first shout at them, then fine, penalty, and in spite of that, if they don't listen to the RBI's regular penalties and other provisions, de-license. Extreme case possible. De-licensing means then your bank will be merged with some other bank. They won't close it down, because if you close down, there are so many FDs, etc., which will be in trouble. So normally they will be merged with some other banks, big banks. That is a problem. It can become an NBFC also. Who told you that? Or is it your idea? Acha, idea. Then it is good. You should always think about ideas. Okay. As a bank, you are making so much of default. As an NBFC, you don't know what you will do. You are a genuine CA student. Okay, you have a bright future ahead. Point number next. It can also be used for meeting shortfall in priority sector lending by swapping such advances with those banks who exceed the priority sector lending obligation. So you can use IBPC for your balance sheet management. Okay, CAR management, liquidity management, even the priority sector lending management you can do through these routes. So one who has lent to priority sector, you take their advance in your books, and then you can show to the RBI that see we have lent to the priority sector. Learn this trick, because in case if you join some bank, then towards the end you can do these things. Okay. Of course, you should not get caught. Otherwise, you will also go where Sanjay Dutt had gone. Salman Khan had gone for a few days. Now, next is ICDs. Huh? Intercorporate deposit. ICD. This is simple. Two companies are there. Reliance Industries Limited, Reliance Communication Limited. Okay. Reliance Industries Limited has lot of funds. Reliance Communication Limited, deficit. They are not able to pay their installments also. So he calls his brother, Anilji calls Mukesh, please bhaiya help me. Okay. Bhaiya says, okay, don't worry. How much you want? 300 crore. Oh, bus. Take this check. But return after 6 months. Okay. And then we'll charge you 9% per annum. That's it. Of course, some Companies Act compliances would be there. But it is very fast, convenient, quick, less documentation, etc. Because you're not dealing with public, okay, so no credit rating, no prospectus, no regulations much, just two parties. Intercorporate market operates outside the purview of regulatory framework. Outside does not mean no regulation is applicable, but not that RBI detailed regulations are applicable. Companies Act is applicable. Of course, Companies Act is applicable. This line should have been little properly drafted. Outside the purview of, you can say, complex RBI regulatory framework. Okay. Like for commercial paper, certificate of deposit, IBPs, there are RBI regulations. But here you don't have to follow complex regulatory framework. It provides an opportunities for the corporates to park their short-term surplus fund. So this is company which has surplus and market rate of interest is 9%. Why he will deposit in bank FD and earn 6%? Why he will deposit in government bond and earn 6.2%, etc. So it's better you can lend to another corporate at market rate and on high rate of interest. This market is predominantly a 90 days market and may extend to a maximum period of 180 days. So generally 3 to 6 months is the maturity period. The market, which witnessed flurry of activities, has received a serious jolt in the wake of a series of default. Earlier there was lot of ICDs. What this note is saying, okay, because it's easy for both the parties. Easy for both the parties. So simple. I'll tell you, I have done one audit of ICD long back. I went to audit ICD, oh, 30 crore rupees. Today I will get to see lot of things in the audit. Then I asked the company, what did you do? He said, see, this is the check number we have issued. That is the only document that we have. I said, where is the board meeting? One line in board meeting. Okay, that also I tick mark. Where is your certificate of loan or register of loan? In register of loan, one line, loan given to. That's it. Came back. Which company I can't say, but it was a listed company. Huh? You were also there. You have also done some similar audits. So it's very simple, no? And they will do all those backdated board meeting entries. Okay, I know. And they get interest also on that. Of course, they will get interest. Shareholders will otherwise shout. All these things they do, but it is very fast. That is why I give you the example of Bhaiya Bhaiya only, na. It's between group companies only mostly, but not necessarily. Not necessarily. So within Tata Group, there are hundreds of companies. So they want to manage the liquidity within the group. Reliance Group, hundreds of companies. Okay, so mostly, as he said correctly, it is within the group because ultimately the owner is the same. Why do companies go for ICDs? Immediate capital for short-term requirement. Transactions are free from bureaucratic and legal hassles. You don't have to submit document, take approval, etc. Better than bank loan also. For the borrower, interest rate is low. For the lender, the interest rate is high. Is it right? If you go through bank separately, see what happens. Suppose this is RIL. It deposit that 300 crore rupees in SBI for 6 months. So how much SBI will give to RIL for 6 months? Maybe 6 to 7% interest rate. Okay, 8% on a higher side. And then SBI will give loan to Reliance Communication at what rate of interest? 12% on a at most lower end. But if these two parties deal directly and say at 9%, he also earns 2-3% more. He pays 2 or 3% less. Right? So better than bank loan for both the parties. That is why these were so popular. Next paragraph. The market of inter-corporate deposits maintains secrecy also because it is just between two parties. Of course, in the balance sheet it will come if it is a listed company. Okay. But it's for a short period. By the time the balance sheet will come, they will knock off also, reverse it also. What happened during the period, maybe you will not know. The brokers in this market never reveal their list of lenders and borrowers. So brokers also have to maintain the secrecy because they believe that if proper secrecy is not maintained, the rate of interest can fall abruptly. So don't disclose who are the borrowers and lenders in the market. Otherwise, they will themselves probably deal with each other and reduce the interest rate. Borrower also, the broker also gets a cut from both the parties. Yes or no? No. Yes. The market of inter-corporate deposit depends crucially on personal contacts. That means generally these two companies know each other. As he said, it is between group companies. The decision of lending in this market are largely governed by the personal contact. That means if the two CEOs know each other, or the chairman of the two companies may be knowing each other, and you need funds, so they arrange for it. Okay, because if you need money, you have to use all the ammunitions that you have. Your business has to run. Okay. Next is again very important. Tick tick. Treasury bill. Treasury bill has been asked in earlier SFM old course, so I expect they will ask you again. And this is a little lengthy part also. Okay, almost 2 pages are dedicated to treasury bills. And again, you have to continuously update yourself because the regulatory framework on treasury bill keeps changing. But overall idea we will get now. So what are treasury bills? In portfolio management chapter also in SFM you have come across this term. The treasury bill rate is 6% and then you use it in CAPM model to find out the return on equity. Okay, RF plus something beta into RM minus. So this is that RF. In many problem of CAPM, the interest rate on treasury bill is used because it's a government bond. So what are the basic characteristic of treasury bill? These are short term promissory note. Short term means maturity period is usually less than 1 year. 364 days is the maximum maturity. And promissory note means you will get your amount back after a certain time period. I promise to pay you. This is what this instrument is. Certain amount after a certain time period at a certain rate of interest. But issued by Government of India. And at a discount. At a discount. Now what do you mean by at a discount? So normally suppose for example, if the face value is rupees 100, the issue price for 364 days will be say 94.50 or something. Okay, and they will not pay you interest separately. So it's like you invest 94.50 today and you will get 100 rupees on maturity. So you are getting an interest of 5.50 on an investment of 94.50. So if they ask you to compute the effective yield, which yield? Effective yield, you have earned 5.50 not on 100 rupees, on 94.50. So that means 5.50 divided by 94.50 will be your effective rate of return, which will be much more than 5.50. Yes, 5.82 or something. So I'm going to solve a question after some minutes once we complete the theory part. And they have asked a question how to compute the yield on treasury bill. Compute the yield on treasury bill. Okay, we'll discuss that point. But right now I was explaining you this concept of discount. Usually the money market instruments are issued at a discount. Usually means not necessarily. Okay, one has to be careful. Next line is what are the benefits of treasury bills? Why do you think treasury bills are issued? Why do you think investors invest in treasury bills? First is treasury bills provide a temporary outlet for short-term surplus. Corporates, mutual funds, banks, insurance companies, they have temporary surplus and they don't want to take any risk with that money because they will need after some days temporary surplus. If you have temporary surplus, you want to keep it as safe as possible. Which is the best alternative out of so many money market instruments? Treasury bill, because these are government security and these are for short term. So in short term government will fail to deliver is rare. Governments also fail. Government also fail. There are some European governments in recent past who refuse to redeem their bonds. Okay. Second benefit of treasury bill is it provides financial instrument of varying short-term maturity to facilitate a dynamic asset liability management. So those who have surplus can invest, okay, and manage their short-term liquidity. They have assured yield. Third benefit, assured yield, because they'll announce in advance only that this treasury bill, this is the yield, and the risk is negligible. Understood? Why treasury bill has negligible risk of default? Because they are issued by government. How is interest rate calculated on treasury bill? Just now I have told you, treasury bills are issued at a discount. The interest rates received on them is the discount, which is the difference between the price at which they are issued and their redemption value. So once again the same example, issue price of a treasury bill is 94.50 and redemption value is 100. This difference is the interest, 4.50, sorry, 5.50. If they ask you what is the effective rate, this will be the base. This is what you have deposited. Okay. Now some presentation in color. Okay. Yes or no? Which is better, color or white? Content is important. You, color is okay. Okay. So next 15-20 slides will come in color font. Okay. Color background. Content is also important. No doubt. That is a given thing. We are not arguing on that. Packaging is also important. So what are the different maturities of treasury bill issued by the government? Government gives a lot of flexibility in this treasury bill market. They have introduced treasury bill of 14 days maturity, 28 days means around 1 month, 91 days means around 3 months, and 364 days, which means around 1 year. And how do they issue treasury bill? Normally auction method is used. Normally auction method is used. Okay. How the auction is conducted? So they will say we want to raise 5,000 crore rupees. See the auction process. Funds to be raised 5,000 crore. Funds to be raised 5,000 crore. These are the people or the banks or the participants who have come in that auction. Okay. So RBI will tell them you submit at what price you want to buy. Rupees in crore and the price per unit rate at which they want to buy. So A says I am willing to purchase treasury bill of 1,000 crore at 95. He says I am willing to purchase 2,000 at 95.10. He says I will buy 500 crore only at 95.20. He says I'll buy 2,000 at 94.90. He says I'll buy 1,500 at 95.30. Okay. And he says I'll buy 1,000 at say 94.80. How will RBI issue treasury bill in this case. Who will get the first priority? Tell me first. Then you can answer easily. Will the RBI first choose the one who is the lowest or the one who is the highest? Of course, highest. He's saying I'm willing to buy at 95.30. So here I am paying him lower rate of interest. The gap between 95.30 and 100 rupees face value is less. So I'll prefer this investor because he's willing to invest at a low rate of interest. But he can only purchase 1500. Then who is the next? 95.20, na? This is 95.20. So this I will first rank, second rank. 500, 2000 gone. Then B third, another 2000 gone. And my target is 5000 crore. So who is the next one? A. 1000. Is it tallying? So coincidentally tallied, so my task is over. Otherwise, whatever balancing figure was there, A. Is it right? This way they do the auctioning. And the others will say, okay, Tata, bye bye, thank you for coming. Have tea and then go. Okay. So this is called auction. This is just a simple example, but that is how many banks they come. And if at the same rate there are more than one banks, if at the same rate there are more than one, let us suppose revise the example. This is 500 and G is also 500. No, this is, I'll make a small correction. This was right, 1000, and G opts for 500 at 95. So in the fourth rank there are two persons, and how much more money I need? 1000 only. So in the ratio of 1000 is to 500, 2 is to 1, the remaining 1000 will be allotted. If there is a tie, then it is allotted proportionately. If it is a tie, it is allotted proportionately. Okay. I'm going to take this problem tomorrow in writing. Don't worry. I have asked my staff to type this example. Huh? Which previous one? Page. I'll give you. Huh. Okay, let us come to the topic. In order to provide investors with instrument of varying short-term maturities, Government of India introduced the auction of 14 days treasury bill since 1997. This 14 days T-bill started only from June 97. So that those who have surplus for 14 days, they can also invest. Further, with a view to develop TB market and moving towards market rate of interest on government security, the auction of 91-day TB was first introduced in 1993. So these are all historical details. 91-day treasury bill issued in 1993 for the first time. 14 days June 1997. The amount to be auctioned will be pre-announced. The amount to be auctioned will be pre-announced. So I had said 5000 crore will be pre-announced, and cut-off rate of discount and the corresponding issue price will be determined in each auction. So every auction is different from previous one. So in each auction, the rate at which they will issue the treasury bill may be different. Okay. Next is the amount and the rate of discount is determined on the basis of bids at the auction. So A, B, C, D, E, F, G had bidded. Who will be issued how much amount, and what is the interest rate we will charge. Okay. The amount to be accepted at the auction and the cut-off prices are decided by RBI on the basis of its public debt management policy. So who will decide finally who will be issued treasury bill, how much, at what rate? RBI. Keeping in mind its public debt management policy, the condition in the money market, and the monetary policy stance. Although state government also issued treasury bills until 1950, since then it is only central government which has been selling them. Underline. If they ask you in a true false question, state government also issues treasury bill. No, it is false. Now they have stopped. It is only central bank which is issuing them. Next line, in terms of liquidity for short-term financing, which is the most liquid asset in the balance sheet? Cash. Then comes call loan. It's for a very short period. And treasury bills lies third in the list. Treasury bill lies third in terms of liquidity. So it is as good as cash only. And then there is a commercial bill, which we'll see after this. Okay. Although the degree of liquidity of treasury bills are greater than trade bills, they are not self-liquidating as the genuine trade bills are. Normally in case of that trade bills, which you have learnt as bill of exchange, you can get it discounted with another bank. Is it right? And that another bank will recover money from the drawee. So it is self-liquidating. There is a date, and on that date the money is received by the discounting bank. So that is why they are called self-liquidating. This asset will be converted into cash as the maturity date will come. T-bills are claim against the government. T-bills are claims against the government and do not require any grading. Means no credit rating is done for treasury bill or further endorsement or acceptance. Following the abolition of 91-day tap treasury bills. Earlier we have seen just now that there was a 91 treasury bill. Now there another type of treasury bill is called tap treasury bill, which is not sold in the auction. There is auction treasury bill, tap treasury bill. Tap treasury bill means you go to RBI and you go to RBI and say I want to buy this treasury bill. That day whatever RBI will say that this is the interest rate I am going to charge you, you buy. That concept of tap treasury bill for 91 days have been abolished. Okay, now you can't go to RBI office and say we want to buy this 91 day. Only when the auction will take place, that time you come. And after that 14 days intermediate treasury bills was introduced with effect from 1st April 97. The 14-day treasury bills are available on tap. Means you can purchase them anytime during working day from RBI at whatever discount rate or interest rate RBI will ask you to, or RBI will offer you. State government, foreign central bank and other specialized bodies with whom RBI has an agreement are only allowed to invest in the treasury bills. Can the CA final article student directly buy treasury bill? You cannot. Who are allowed? State government, foreign and central banks and other specialized bodies like money market mutual fund, commercial bank. They can only invest in the treasury bills or primary dealers. Okay. Means this investment is not available for retail investors, corporates. Okay. Then if you want to invest in them, you have to invest through money market mutual fund. Because then money market mutual fund investing treasury bills. They are allowed. Treasury bills are issued at a discount and their yield can be calculated with the help of following formula. See the formula. Where is the formula? Formula is not appearing. I will write. Formula is F minus P upon P into 365 by N into 100. Okay. Now for example, a 91-day treasury bill. Face value is 100. Issue price is 98. And then the institute is asking you, what is the annual yield on this treasury bill? What is the annual yield? Means what is the rate of return the investor is earning on this? So apply this formula and then see the logic of this formula. You have invested 98 rupees, but you will get on maturity 100 rupees. So how much you earned? 2 rupees. This is the question. Okay, basic data I have written. So you will earn 2 rupees. What was your investment? 98. Ignoring time, right now you earn 2 rupees on 98 rupees. 2 rupees you earned on an investment of 98, 2 by 98. For how many days you have to keep this investment? 91. So if I want to earn, had you invested for 1 year, in 91 days, this is my return. Mathematics. In 91 days, I earned this return 2 by 98. So in 365 days, what would be my return? So you can see the mathematics, 2 by 98 into 365. Are we not cross multiplying this 2 and divide by 91 and multiply by 100? So that will give you the percentage, 8 point some percentage. 8.18%. 8.18%. Okay, this is a 2-mark question in the exam. Many times student write 2%. Some more intelligent will write 4%. Even more will write 8%. Because he says 91 means 3 months. So for year 4 times more. Even 8% the institute will not accept. Okay. Now we'll take a small 5 minutes break.